Welcome back to XRP Economic Radar, your trusted source for the latest crypto market news, XRP updates, Bitcoin analysis, and everything moving the digital asset space. Today we're covering a major sell-off that has shaken traders across the market as Bitcoin, Ethereum, XRP, and most major altcoins have dropped sharply. Investors are asking one question right now: why is the crypto market going down today? The answer involves a combination of Federal Reserve policy, massive liquidations, technical breakdowns, and growing uncertainty about the direction of the global economy. Over the last 24 hours, the total crypto market has lost significant value, falling nearly 4.5% and bringing the overall market capitalization down to roughly $2.15 trillion. Bitcoin plunged below $63,000, Ethereum slipped under key support levels, and XRP saw heavy selling pressure as fear quickly spread throughout the market. This decline happened fast, catching many traders off guard and triggering a wave of liquidations that accelerated the move lower. While sharp corrections are nothing new in crypto, the speed and scale of this latest drop have created serious concern among investors who were expecting the market to continue recovering after recent gains. The biggest trigger behind today's decline appears to be the latest message coming from the Federal Reserve. While the Fed decided to keep interest rates unchanged during its June meeting, the tone of its comments was much more hawkish than many investors expected. Markets had been hoping for stronger signals that rate cuts were coming soon. Instead, policymakers suggested fewer cuts than previously anticipated. That immediately strengthened the US dollar and reduced appetite for risk assets across financial markets. Cryptocurrencies often struggle when the dollar strengthens because investors shift towards safer investments and away from speculative assets. As soon as traders digested the Fed's comments, selling pressure accelerated across crypto markets. Bitcoin led the decline, dragging the rest of the sector down with it. The reaction highlights just how sensitive crypto remains to macroeconomic developments and monetary policy decisions. Even though blockchain adoption continues growing globally, short-term price action is still heavily influenced by central bank decisions and investor sentiment surrounding interest rates. The impact on Bitcoin was immediate and dramatic. Within just a couple of hours, Bitcoin dropped by roughly $2,000, falling below the important $63,000 level. During the same period, more than $200 million worth of bullish crypto positions were wiped out as leveraged traders were forced out of the market. Bitcoin alone accounted for over $100 million in liquidations during the past day. What makes this particularly important is that roughly 71% of those liquidations were long positions, meaning traders were overwhelmingly betting on higher prices. When prices started falling, automatic liquidations created additional selling pressure, which pushed prices down even further. This type of liquidation cascade is common during highly leveraged market environments and often creates sharp declines that appear larger than the initial catalyst would normally justify. As a result, what began as a reaction to Federal Reserve comments quickly turned into a broader market-wide sell-off fueled by forced liquidations and panic selling. Ethereum also suffered substantial losses as bearish sentiment spread across the market. The second largest cryptocurrency dropped nearly 5%, falling toward the critical $1,690 to $1,700 support zone that many analysts have been watching closely. Ethereum remains one of the most important assets in the crypto ecosystem due to its role in decentralized finance, tokenization, and blockchain infrastructure. However, even strong fundamentals cannot completely shield assets from macro-driven market corrections. Investors are now paying close attention to whether Ethereum can successfully hold its long-term ascending trendline, which dates back several years. This is reportedly the third major test of that support level, making it a crucial technical battleground. If buyers step in and defend the area, Ethereum could stabilize and potentially lead a recovery. If support fails, however, the market could face another wave of selling pressure that would likely impact the broader altcoin sector as well. XRP was not spared from the market turmoil and experienced one of the steeper declines among major cryptocurrencies. The digital asset dropped more than 6%, falling toward the $1.13 region as traders reduced exposure to risk. Despite the short-term weakness, many XRP investors remain focused on the bigger picture. Market participants continue watching the important $1.21 level, which has repeatedly acted as a barrier to sustained upside momentum. XRP has managed to move above this level before, but previous breakout attempts failed to hold. Analysts suggest that a successful close above and sustained hold beyond $1.21 could significantly improve the technical outlook. Until that happens, XRP remains trapped in a waiting phase where traders are looking for a catalyst capable of driving a more decisive move. For now, broader market weakness has overshadowed many of the positive developments that XRP supporters have been highlighting in recent months. One of the clearest indicators of current market sentiment can be found in the Fear and Greed Index, which has fallen to a reading of just 19. That places the market deep into what is known as extreme fear territory. Historically, extreme fear often appears near major market bottoms because investors become overly pessimistic after sharp declines. However, it can also signal that uncertainty remains high and that volatility may continue in the near term. Traders are currently balancing fears of additional downside against hopes that the market could be approaching a stabilization zone. The rapid decline in sentiment demonstrates how quickly investor psychology can change in crypto. Only weeks ago, many market participants were discussing recovery scenarios and bullish breakouts. Today, conversations are increasingly focused on downside risks, support levels, and the possibility of an extended correction. This shift in sentiment is one reason why the coming days could be especially important for determining the market's next direction. From a technical perspective, Bitcoin is now sitting near one of the most important support zones on the chart. Analysts are closely monitoring the region between approximately $62,000 and $64,000. So far, sellers have not managed to push decisively below this area, which is encouraging for bullish investors. However, there is also significant resistance waiting above current prices. Liquidity is reportedly concentrated around the $68,000 level, meaning any recovery attempt could encounter substantial selling pressure before momentum can build. This creates a challenging environment where Bitcoin must first hold support and then overcome heavy resistance if it hopes to regain a bullish trend. The next several trading sessions could therefore prove critical. The successful defense of current support could encourage buyers to return, while a breakdown could increase fears that a much deeper correction is beginning to unfold. Looking at the broader crypto market, the total market capitalization level around $2.1 trillion has become a major focus for traders. This area represents a significant technical floor and serves as a key reference point for determining whether the current correction remains manageable or develops into something more severe. If the market can remain above this level, analysts believe a rebound toward approximately $2.22 trillion remains possible. On the other hand, a decisive break below $2.1 trillion could open the door to deeper losses and potentially trigger additional selling from investors who have been waiting on the sidelines. Technical traders are also paying attention to Fibonacci retracement levels, which suggest that a break lower could expose the market to further downside targets. As always, maintaining key support zones is essential for preserving confidence and preventing panic from spreading further. Another important metric being closely watched is Bitcoin dominance, which currently sits near 58%. Bitcoin dominance measures the percentage of the total crypto market represented by Bitcoin itself. When dominance rises sharply, it often indicates investors are moving away from altcoins and seeking relative safety in Bitcoin. When dominance falls, it can suggest growing confidence in alternative cryptocurrencies. Stabilization around current levels could signal that the market is beginning to find balance after the recent sell-off. However, continued movement into cash and stablecoins could indicate that risk aversion remains elevated. Understanding dominance trends is especially important for XRP investors because altcoins often struggle when fear dominates market sentiment. If Bitcoin stabilizes and dominance levels settle, it could create conditions for altcoins to recover alongside the broader market. Beyond technical analysis, traders are also watching potential regulatory developments that could influence crypto prices. One of the most closely monitored events is ongoing discussion surrounding the Clarity Act in the United States. Regulatory clarity has historically been viewed as a positive catalyst for digital assets because it reduces uncertainty for institutions and investors. XRP supporters are particularly interested in these developments given Ripple's long legal battle and the importance of clear regulations for future adoption. Positive progress on legislation could quickly shift market sentiment and provide a new narrative for investors looking beyond short-term macroeconomic concerns. While regulatory headlines often create volatility, they can also unlock opportunities when they provide certainty and encourage institutional participation. For now, traders remain focused on any signals that could improve confidence and reverse the current bearish mood. Economic data remains another major factor influencing market expectations. The next U.S. inflation report and future comments from Federal Reserve officials may ultimately determine whether this latest hawkish message represents a temporary adjustment or the beginning of a more prolonged policy stance. If inflation continues to cool, markets may regain confidence that rate cuts could still arrive in the future. If inflation remains stubbornly high, however, policymakers may maintain restrictive policies longer than expected. Crypto investors understand that liquidity conditions play a major role in market performance. During periods of easy monetary policy, risk assets often thrive. During periods of tighter financial conditions, volatility and downside pressure tend to increase. That is why upcoming economic reports are likely to receive enormous attention from traders searching for clues about the next phase of market behavior. Adding to the uncertainty is a new technical analysis framework presented by market analyst Gareth Soloway. According to Soloway, Bitcoin is currently testing one of the most important levels on its chart around $63,500. He notes that Bitcoin recently rallied from a double bottom pattern toward $67,200 before pulling back. Such pullbacks are often considered healthy within larger uptrends, but the significance of the current test cannot be ignored. The area being challenged now represents the location where the original breakout occurred, making it a critical support zone. If Bitcoin successfully holds above this level, the path toward $70,000 remains viable. If support fails, however, confidence in the double bottom structure weakens significantly. Repeated tests of support generally reduce its strength over time, increasing the risk of a larger breakdown if buyers fail to defend the area. Soloway's longer-term outlook has attracted significant attention because it includes a potential worst-case scenario for Bitcoin. Looking at higher time-frame charts, he identifies a possible head and shoulders pattern that could imply a measured move toward approximately $35,000. While he emphasizes that this represents a bearish scenario rather than a certainty, the possibility has understandably raised concerns among traders. Interestingly, Soloway has stated that he would view substantial declines as accumulation opportunities rather than reasons to abandon the market. According to his strategy, he would gradually increase Bitcoin purchases at progressively lower levels, beginning around $50,000 and continuing through $45,000, $40,000, and potentially even $35,000. His perspective reflects a common approach among long-term investors who view major corrections as opportunities to build positions rather than simply sources of fear. While Bitcoin dominates most headlines, attention also remains focused on the outlook for XRP. Many XRP investors continue discussing ambitious long-term price projections tied to global financial infrastructure adoption. Some analysts argue that XRP could benefit from increasing involvement in cross-border payments, tokenized asset settlements, and the modernization of traditional banking systems. These projections rely on assumptions regarding market share capture and institutional adoption. Supporters believe XRP's legal clarity and existing relationships within the financial sector could provide competitive advantages if adoption expands. Critics argue that many of these projections remain speculative and depend on variables that are difficult to predict. Nevertheless, the discussion highlights why XRP continues attracting strong interest despite periods of market weakness. Investors remain divided between short-term technical concerns and longer-term visions of global utility. Meanwhile, broader concerns about Bitcoin's future cycle have resurfaced following additional bearish forecasts for 2026. Some analysts believe historical correction patterns suggest the current downturn could continue for several more months before reaching a final bottom. Previous bear market cycles lasted more than 400 days, and some observers see similarities developing once again. Under these scenarios, major demand zones could emerge between roughly $30,000 and $40,000 depending on the severity of the correction. Technical indicators including RSI, MACD, and the Awesome Oscillator continue showing signs of weakness, contributing to cautious sentiment among traders. Prediction markets have also reflected declining confidence regarding the timing of Bitcoin's return above $100,000. Although these forecasts are far from guaranteed, they demonstrate how divided market participants remain about the direction of crypto prices over the next year. Not all digital assets are struggling equally, however. Stellar, known by its ticker XLM, has recently shown notable strength despite broader market weakness. The cryptocurrency surged sharply after breaking above a multi-month resistance level and reclaiming the important $0.24 area. Analysts note that this represents one of Stellar's most meaningful technical improvements in months. The breakout has been accompanied by stronger trading volume and improving market structure, encouraging traders who believe a move toward $0.30 could be possible. As long as XLM maintains support above its recently reclaimed levels, bullish momentum may continue. The performance of Stellar serves as a reminder that even during difficult market environments, individual assets can sometimes outperform and attract investor attention through strong technical setups and positive momentum. As we wrap up today's market update, the key takeaway is that the crypto market's decline appears to be driven by a combination of hawkish Federal Reserve signals, a stronger US dollar, heavy liquidation activity, and growing uncertainty about the economic outlook. Bitcoin, Ethereum, XRP, and many altcoins have all felt the pressure, while investor sentiment has fallen into extreme fear territory. Yet despite the short-term volatility, critical support levels remain intact for now, and several potential catalysts, including